How is it that um, tech giants are projecting to spend over $700 billion to build an artificial intelligence future? But publishers are so terrified of that exact same future, they are stalling a $2 million debut book deal.
It's wild.
Right. I mean, welcome to the deep dive. It is Friday, July 34th, 2026. Today, we're looking at a truly massive stack of updates from the Daily Tech Reader's nightly news. And I just got to say, looking at the sheer volume and variety of these sources today, it feels like we're living in like 3 or 4 entirely different realities all at once.
Oh, it really does. I mean, you look at one headline and it feels like the geopolitical map is fracturing. Then you look at the next, and we're achieving things in deep space that sound like pure science fiction.
Yeah.
And then, you look at the financial markets and they just seem completely detached from everything else happening on the ground.
Exactly. And, well, that is our mission for you today. We're going to cut through this absolute mountain of information overload from today's news cycle. We want to extract the connective tissue for you. How does global geopolitical friction connect to these wild macroeconomic shifts, which then tie into this historic artificial intelligence spending boom, all while extreme weather is literally happening in our own backyard?
It's all connected.
It really is. Okay, let's unpack this, starting with the geopolitical tightrope.
And this is an incredibly delicate situation right now, specifically regarding the ongoing friction involving the U.S. and Iran.
Right. And just to pause here before we get into details, before we discuss President Trump's statements, the military strikes, and all the conflicting claims between different nations, we really need to be incredibly clear with you, the listener. We are not taking sides here. We're not endorsing any political viewpoint or international claim, whether from the left, the right, or abroad. Our job today is strictly and impartially to report the claims and events exactly as they're documented in our source material from the Daily Tech Reader.
Right, because neutrality is key here. The facts on the ground are just incredibly complex. So let's look at the timeline. Right now, we've just hit the halfway mark of a 60-day Memorandum of Understanding, or MOU, between the U.S. and Iran.
Which is basically a formal agreement that outlines a framework for negotiation.
Right, exactly. That 60-day window opened on June 17th, and the deadline is looming right around the corner on August 17th.
But despite that negotiating window technically being open, the conflict on the ground is very much active. It feels like this MOU is a ceasefire on paper, but in reality, it's like a ticking shot clock where both teams are somehow still throwing elbows on the court.
That's a good way to put it.
We have President Trump speaking at a Camp David cabinet meeting, telling reporters he is concerned with Iran after Tehran fired missiles at U.S. forces in Jordan while these negotiations were underway. He didn't rule out a deal, but the human cost is mounting. The Department of Defense just updated its casualty database. They added 32 more wounded troops.
And the escalation, it isn't contained just to Jordan. There was a drone strike on a U.S.-owned gas tanker at Egypt's Damietta port.
Wow.
Yeah, and this incident perfectly illustrates that fractured geopolitical landscape because you have completely contradictory narratives. You have Iran's foreign minister, Arachi, publicly denying Tehran's involvement. He outright called it an Israeli false flag operation meant to undermine regional stability.
But Egypt sees it completely differently.
Exactly. Egypt's foreign minister called the incident a shared threat that requires Muslim solidarity.
And the economic levers are being pulled right alongside the military ones. We're seeing the U.S. Treasury issuing fresh sanctions targeting entities that support Iran's Mahan Air network. Analysts at the Council on Foreign Relations are pointing out that the U.S. is facing the exact same strategic dilemmas that have defined this conflict from the start. Nothing has fundamentally been resolved.
Which is why this matters directly to you, the listener. Geopolitical instability doesn't just stay neatly contained in the Middle East. It ripples outward instantly into the physical supply chain. Because of this friction, commercial traffic through the Strait of Hormuz is faltering. Cargo ships and tankers are just hesitating or rerouting entirely.
And we're seeing oil prices reacting to that. The sources showed WTI crude hitting around $85 a barrel and Brent crude nearing $90.
So for those who don't follow the commodities market daily, is it fair to say those rising oil prices are essentially the real-time economic scoreboard for this military tension?
That's a really great way to look at it. The oil market price is in risk. The Strait of Hormuz is a massive bottleneck for global energy.
When tankers can't safely navigate it, the global supply of oil threatens to tighten. The market panics about a potential shortage, so the cost of energy goes up globally. And that rising cost of energy trickles down into literally everything you buy because, well, Everything has to be transported.
Which brings us to the actual wallets of the consumers. Because you, the listener, you're the one paying the price of that $90 barrel when you fill up your car or buy groceries. And this creates a perfect transition into the economic pressure cooker that average consumers are currently trapped in.
Oh, the squeeze is very real. And the newly released data from the Bureau of Labor Statistics shows exactly how tight it is. The Employment Cost Index, which basically measures how much employers are paying out in wages and benefits, it went up 0.9% in the second quarter. So annual wage growth is sitting at 3.4%.
Okay, 3.4% wage growth sounds like a positive thing on paper. Like, hey, I'm making more money,
Yeah.
but how does that actually help me if inflation is running hotter than my raise?
It mathematically doesn't. I mean, that 3.4% wage growth is still trailing the Consumer Price Index, or CPI, which is running at a 3.5% pace right now.
Ouch.
Yeah, and even worse, if you look at core PCE inflation, it's holding steady at an elevated 3.7%.
Wait, remind me, why do we care about core PCE specifically?
So core PCE stands for personal consumption expenditures. But the core part is what really matters. It strips out the highly volatile stuff like food and gas. The Federal Reserve watches it closely because it shows the true underlying trend of inflation in the economy.
Got it.
And with it stuck at 3.7%, it means the base cost of living is still rising faster than wages. Your paycheck is mathematically losing a daily tug of war against prices.
And borrowing money to bridge that gap is getting punishingly expensive. I was looking at the bond market numbers in the daily tech-reader stack. The 10-year Treasury touched 4.73% intraday, and the 30-year yield hit 5.25%. What does a 5.25% yield on a 30-year bond actually mean for a normal person's life?
It puts immense upward pressure on anything rate-sensitive in your life. The 30-year Treasury yield basically acts as a benchmark. When it hits 5.25%, which, by the way, is the highest level we have seen since 2007, right before the Great Financial Crisis.
Oh, wow, 2007.
Yeah, it means the cost of a 30-year mortgage is going to stay painfully high. It means the interest rates on your credit cards and your auto loans aren't coming down anytime soon. The bond market is basically signaling that it expects inflation and therefore high interest rates to just stick around for a long time.
But then, amidst all of this, the University of Michigan's final July consumer sentiment reading showed a broad pickup. People are reporting that they feel better about things. I really struggle to understand that. I mean, it's like running on a treadmill that keeps speeding up. How can consumer sentiment actually be picking up when real wages are losing a daily tug-of-war against inflation, energy costs are climbing due to drone strikes, and the 30-year yield is hitting levels we haven't seen since 2007? It makes no sense.
If we connect this to the bigger picture, you have to look at the psychological effect of the stock market.
Oh, interesting. Because despite all those incredibly heavy, very real consumer burdens you just listed, U.S. markets closed July on a decidedly upbeat note. The Dow was up 0.5% on Friday, the S&P gained 0.7%, and the Nasdaq rose 1.3%. July actually marks the Dow's fourth consecutive winning month. People look at their 401ks, they see the green arrows on the news, and it creates this sort of psychological halo effect.
So the stock market is just completely ignoring the fact that the consumer is getting squeezed.
It's not ignoring it. The consumer data is just being entirely eclipsed by something else. The broader stock market is being artificially lifted by a force completely separate from the daily consumer budget. We're witnessing an unprecedented wave of corporate technology spending that is single-handedly propping up these major indexes.
And that takes us right to the Mag 7 tech giants and this absolute capital tsunami we're seeing in artificial intelligence. When I was reading the earnings reports in our source material, the numbers were almost difficult to comprehend. They are staggering. The major cloud hyperscalers, and here we're talking about Amazon, Microsoft, Meta, and Alphabet, they just signaled to investors that their AI infrastructure spending is accelerating. They are forecasting a collective $720 to $745 billion in 2026 capital expenditures.
Over $700 billion in one single year. That's like building an entirely new country's infrastructure, the roads, the bridges, the power grid from scratch in 12 months.
Well, exactly.
And Amazon seems to be the absolute vanguard here. Their second quarter results were a blowout. Total revenue was $200.6 billion, up almost 20% year over year. And their cloud computing division, AWS, hit $42.2 billion at a nearly 40% operating margin.
And look at where their CEO, Andy Jassy, is deploying that massive pile of cash.
Yeah.
He is betting aggressively on their custom Graviton 5 chips, expanding their Bedrock AI models, pouring money into Zoox robotaxis, and the Amazon Leo satellite network. Prediction markets are currently giving it a 98.4% probability that Amazon's 2026 capital expenditures alone will top $170 billion.
Wow.
Unsurprisingly, the market loved it, and their shares surged 12%.
But then you look at Apple, and it's a totally different story. They had a record June quarter, pulling in $109.4 billion in revenue, but their shares actually dropped 8%. The sources mentioned their gross margins were artificially boosted by one-time tariff refunds. Can you explain how a tariff refund masks a company's true performance?
Sure. A tariff refund happens when a company proves they shouldn't have had to pay a certain import tax in the past, and the government cuts them a massive refund check. So Apple's bottom line looked fantastic this quarter, but that money came from a one-time government refund, not from, selling more iPhones.
Ah, I see.
Once you strip that refund away, investors saw incredibly soft forward guidance driven by very weak sales in China and the rising costs of internal components. And notably, this was Tim Cook's final earnings call as CEO.
Does Apple's 8% drop on Tim Cook's final call signal a harsh new reality? Are we entering a phase where you are either an AI builder spending hundreds of billions of dollars on infrastructure, or you're just a legacy hardware seller being left behind?
It certainly looks like a changing of the guard in the tech world. But what's crucial to understand is that this AI infrastructure boom isn't just an American story anymore. The capital being deployed by companies like Amazon and Microsoft is actively reshaping the global economy.
Right. This is triggering a global chip war. Look at South Korea. Their KOSPI index surged 18% in a single day.
Huge.
The largest single-session gain in the history of that index. And it was entirely because their memory chip maker, SK Hynix, hit a 30% daily trading limit based on overwhelming AI demand, pulling Samsung Electronics up 27% right alongside it.
And the economic ripples go straight into China, too. A Chinese memory chip maker named CXMT just debuted on the Shanghai Stock Exchange, and it surged 531% on its first day of trading.
531%. That gives them a market cap of $487 billion, making CXMT China's most valuable listed company overnight. Their first quarter revenue grew 719%, and they confirmed they are beginning high bandwidth memory, or HBM, production in 2026. Why is HBM so critical to this AI boom?
Well, because artificial intelligence requires moving massive, unfathomable amounts of data simultaneously to train its models. Standard memory chips just can't physically pipe the data fast enough. High bandwidth memory, or HBM, is exactly what it sounds like. It widens the pipes so the AI processors can digest data at lightning speed.
Right.
By domesticating HBM production, CXMT is rattling global rivals like Micron and SK Hynix. The AI boom is essentially minting sudden, massive economic superpowers in South Korea and China because they supply the physical picks and shovels for this digital gold rush.
Here's where it gets really interesting, though. We have these tech giants, like Amazon, spending $170 billion to build out the physical infrastructure for AI. But at the exact same time, the creative and entertainment industries are actively, aggressively fighting the implementation of it.
Oh yeah, the culture clash is becoming very tangible.
Exactly. I mean, Amazon MGM just dropped the studio backing for a high-profile television drama called Artificial, which was entirely about the founding of OpenAI. They didn't drop it because of bad scripts. They dropped it because of growing industry sensitivity and severe copyright concerns around AI-focused content.
Yeah.
Separately, there was a massive $2.4 million debut novel deal for a book called Call Me, I'll Hide the Body. That deal is now totally stalled because publishers are terrified of possible AI involvement in the writing process. Are we hitting a point where AI is so legally radioactive that you can't even make a TV show about it?
What's fascinating here is how the market is reacting to that uncertainty. While the legal system scrambles to catch up to this unprecedented technology, both consumers and studios are rapidly retreating to the absolute safety of known human-driven entertainment.
Safe bets.
Exactly. When the future feels legally and creatively murky, the industry aggressively banks on nostalgia and legacy intellectual property.
And that retreat to safety is highly lucrative. Cinemark just posted a record second quarter, crossing $1 billion in revenue for the first time in company history. And what's driving it? Pure nostalgia. The Super Mario Galaxy movie, Toy Story 5, and the Michael Jackson biopic, Michael. Plus, Sony's Spider-Man. Brand New Day is projecting a $300 million+ domestic debut weekend. It's a complete rejection of the unknown.
And you see the exact same pattern playing out in television and streaming. Netflix isn't gambling on untested AI-generated sci-fi universes.
Right.
They just signed a 5-year, $500 million co-exclusive deal with AMC for the Walking Dead universe.
Wow.
Yeah, they are paying a premium for human-acted spin-offs of a legacy property.
Even Disney is consolidating its legacy assets. They're selling their 50% stake in A+E Global Media, which includes the History Channel, Lifetime, and Vice TV, to Hearst for more than $1 billion. That deal gets formally announced August 5 alongside their earnings.
But if we're talking about the ultimate premium on human-driven entertainment, you really can't get more purely human than live sports. And the sports world is seeing massive ripple effects right now.
Totally. LeBron James just signed with the Philadelphia 76ers. Agents are reporting an absolute surge in contract and trade activity across the entire NBA as everyone scrambles to respond to how he just reshaped the Eastern Conference.
And Major League Baseball is right in the thick of it with the August 3 MLB trade deadline coming up on Monday.
Yes, and we are seeing teams get highly protective of their human assets. The Detroit Tigers scratched a perfectly healthy Casey Mize from his Friday start. The Mets scratched Freddie Peralta. Why pull a healthy starting pitcher right before a game?
To completely eliminate the risk of injury. When a team knows they are going to trade a player for future prospects, that player becomes a highly valuable, highly fragile asset.
Right.
One bad pitch, one tweaked elbow, and millions of dollars in trade value just vanish instantly. So teams put them in bubble wrap.
That makes perfect sense, especially with a guy like Tarek Skubal, who is the absolute center of the baseball universe right now. He has 7 massive suitors: the Dodgers, Yankees, Brewers, Rays, Braves, Cubs, and Phillies. But it highlights how incredibly risky human talent is. Look at Curtis Mead, whom the Red Sox just acquired. He fractured his wrist in his very first game with Boston. Or the Twins' Byron Buxton, who just went back to the injured list with a hip impingement.
It perfectly illustrates the fragility of human talent compared to the endless, untiring compute of those AI data centers we were just talking about. A server farm doesn't pull a hamstring or fracture a wrist.
That's such a good point, which actually provides the perfect lens to look at our final big theme today. Because while we're debating virtual AI environments and the fragility of a baseball player's wrist, our actual physical planet is putting on a dramatic show of its own, reminding us just how fragile our physical infrastructure really is.
And it is a severe reminder. Right now, there is a dangerous heat wave baking the American Southwest. The Weather Prediction Center is forecasting temperatures between 110 and 120 degrees Fahrenheit in parts of California, Nevada, and Arizona.
Unbelievable.
And this heat dome isn't staying put. It's expanding into the Intermountain West and the northern high plains this weekend.
It's brutal. Dallas-Fort Worth is looking at a high of 104 degrees today, with a heat index up to 110. They're waiting on a cold front tonight that might bring some gusty, severe storms across the Gulf Coast and Midwest, but that triple-digit heat is just going to rebuild by next week.
And if the blistering heat wasn't enough, we are dealing with massive air quality issues. NASA's Scientific Visualization Studio is tracking huge brown carbon smoke plumes drifting down from Canadian wildfires. This smoke is blanketing the U.S. Northeast and Midwest, triggering dangerous air quality alerts all the way from Michigan over to Boston.
Okay, so this is where my mind just kind of melts. We are literally choking on wildfire smoke in Boston, and we are baking in 120-degree heat in Nevada. We are incredibly vulnerable to our environment. But at the exact same time, NASA is releasing this stunning time-lapse video from their Psyche spacecraft.
Oh, that video is incredible.
Right. Back on May 15th, Psyche executed a flawless gravity assist around Mars. It sent massive amounts of data back to Earth, validated all its scientific instruments, and kept itself perfectly on track for a 2029 arrival at a metal-rich asteroid deep in the solar system.
And we're seeing that same resilience on the human health front. While Moderna shares fell 6% after a second quarter earnings miss, the scientific literature is advancing. We just got data from a new 3-year clinical trial showing that taking a simple daily multivitamin actually helps older adults maintain better functional health and live independently for significantly longer.
I just marvel at this juxtaposition of human capability. We are grounded by smoke, yet navigating around Mars. We're fragile enough to fracture a wrist playing baseball, yet clever enough to extend human independence with a daily vitamin. Are humans just fundamentally built to thrive in extremes?
This raises an important question about the duality of our current era. When you step back and synthesize all this, You see a species that is experiencing profound vulnerability to our home planet's climate. We are entirely at the mercy of heat domes and wildfire smoke.
Yeah.
Yet paired right alongside that vulnerability is breathtaking scientific ambition. We can calculate the exact mathematical trajectory needed to slingshot a satellite around Mars to catch a metal asteroid years in the future, and we are relentlessly studying how to extend human health span at the cellular level.
So what does this all mean for you listening right now? Why should you care about this wide spectrum of news from the Daily Tech Reader? Well, it comes down to this. Having a 30,000-foot view is your ultimate superpower in an increasingly complex world. When you can see the unseen mechanisms, how to drone strike in the Middle East, tightens shipping in the Strait of Hormuz, which bumps oil to $90, which squeezes your personal grocery budget against a 3.7% core PCE inflation rate, you stop being surprised by the world.
Exactly. And when you understand the mechanics behind the stock market's current euphoria, that it isn't reflecting consumer health, but rather a $745 billion AI infrastructure build-out that requires high bandwidth memory and is minting new corporate superpowers in China and South Korea, you can make vastly more informed decisions about your own life, your career, and your investments.
You see the Matrix. You see exactly why Hollywood is hiding in the nostalgic safety of Toy Story 5 and live sports, while Silicon Valley is desperately trying to build a brand new form of intelligence.
Which leaves us with one final provocative thought to consider based on everything we've looked at today. We are watching tech giants pour an almost unfathomable $745 billion into the physical infrastructure of AI, the chips, the servers, the immense energy grids required to power it all.
Right.
But at the exact same time, we saw a $2.4 million book deal and a major Amazon television drama stall out completely due to industry fears over copyright infringement.
Yeah, that's such a wild contrast.
It really is. So could it be that the ultimate bottleneck for our futuristic AI world won't actually be a lack of microchips or a shortage of data centers or even limits on computing power, but simply the archaic 20th century legal frameworks of copyright law? It is entirely possible that the courts, not the software engineers, will ultimately determine the speed of this technological revolution.
That is a fascinating thought to end on. It's not the hardware holding us back. It's the rulebook. Well, we hope this deep dive helped you connect the dots today and gave you some clarity amidst the noise. Keep questioning the world around you, keep looking for those hidden connections, and we will catch you on the next deep dive. Take care.